Had to set up YouTube and everything. Cool. I figured if I start the class, some people would show up. See if I could have someone to talk to this morning. Good morning, everybody. Hope you had a great weekend. Excuse me. Hope you had some fun, did some cool stuff, made some friends. Welcome to the room. Welcome to Monday. Today is Monday, March 31st, guys. It is the last day of March already. This week is flying, or this month is, this year. It's a year. The year is flying. And we're checking that news, and guys, there's nothing but a little Chicago PMI at 9:45. It is low impact news. Probably not even going to pay attention to it. But every morning, forexfactory.com/calendar. Like to see what's going on in the wonderful world of news, guys. Not because I'm worried about the news release. When I look, there's no part of me that gets excited or worried or nervous or anything about the Chicago PMI. What I'm looking for is these red boxes, and I'm looking for these orange boxes, and we don't have any until tomorrow. But those high impact news releases, those are the ones that make a market spike typically, that can change its direction, that can make it too fast really to make good decisions. So this is one of my morning routines. When I wake up, I studied yesterday's trades or Friday's trades, got my head straight coming into the week, and then I go check news and I make sure that there's nothing that's going to release that could take away my advantages, because everything I do revolves around advantages. The advantages that we teach in this room can be found on the Nexgen page. I'm gonna say that word a lot today. I think I'm gonna say the word patterns and advantages an awful lot today, because that's really what we do. Next-gen software is, in my opinion, the greatest tool you can have as a trader. But it's important that you learn to read it. Just owning it doesn't make you an amazing trader. Good morning, Steve Diego. Saw that one. You've got to learn to read your software. You've got to learn to understand what you're looking at, and what it means to you. And guys, we're going to cover it and we're going to talk about it. We're going to do that through what we call a high probability trend trade. This is going to be our focus for the entire first hour of class. And the high probability trend trade, is this it right here? Is only 3 rules, guys. It's not an elaborate approach to using the software. It's actually the absolute most basic remedial approach to using the software that I could come up with to make the education path as easy as possible. And we focus on this high probability trend trade for a couple reasons. First, it's a trade that when you follow the rules, typically wins 70 to 80% of the time. And that's a pretty outstanding win percentage. There's a saying that confidence comes through the memory of success. So the more you're successful, the more confident you become. And the more confident you become, honestly, the more likely you are to follow your rules. But the most important thing that this high probability trend trade does for you is it's going to teach you to read your indicators. It is going to teach you to look at your charts and to be able to say, I have what I need to enter a trade. I have the advantages in play so that I can take the trade. And the high probability trend trade is only 3 rules, guys. That's it. And it's the chart read that puts you in the trade. It's the rules being met that puts you in the trade. And what you're going to find when you learn to read your indicators is that about 90% of your day is just reading indicators. 90% of your day is sitting on your hands, not doing a whole lot, waiting for advantages because, hey, good morning, 10K. Good to see you posted in here. Because when you have advantages, that's awesome, Wayne. The old Kushitanis. When you have the advantages, that's when it's time to take a trade, guys. Your rules for the high probability trend trade, and hopefully for any rule that for any trade that you're taking, is nothing more really than a description of a pattern. Patterns repeat themselves in the market all day, every day. Patterns are what help you recognize advantages, guys, And once you learn how to recognize a few advantages, a few patterns, you're going to understand some pretty key concepts like where the market is likely to continue. We're going to use that one as your entry for the highest probability trend trade. You'll understand where the market is likely to go. This is going to help you with profit targets. And then finally, you're going to understand where the market is likely to stop. And we call these termination conditions. And likely to stop areas do just that. They can stop a market cold in its tracks, no matter how fast it's moving, no matter how long it's been moving. And you are going to have the advantage of understanding where highs and lows in the market can happen. And you'll have a simple little recipe to understand whether or not that's happening. And that's what we're going to do. We're going to focus on chart reads today. We're going to do it with only 3 rules because that's all it takes. It's 3 rules. It is each rule being true provides an advantage, and it's the advantages that should get you into a trade, guys. Every time you get into a trade, you should feel confident. Every time you get into a trade, you should say, I have this going for me. Or as you grow with the software, you might say, I have this working against me. I need to manage a little bit. But we're going to focus on just 3 rules, best of the best. And to enter a trade, you'll have the advantages of momentum, a clear path, and an entry area. And these 3 rules happen on only 2 charts. Simplicity is really my focus. Large chart leads the way. Large chart is a very slow moving chart, guys. It's a very broad stroke of a brush, but it gives an awful lot of information. Your large chart will define the direction you should be looking for rules to be met. The large chart will define the momentum in the market. That's rule number 1, being true, giving you that first advantage. And the large chart will define those areas that could stop the market, that could create bounces. So rule number 2, making sure that you have a clear path, is met on the large chart. And really, to make it even easier, it's the first bar. The first bar lets you know everything that you need to know. It gives you 66% of your advantages. It's that first bar in the information your indicators give you right there that's going to send you to a smaller, faster chart to find your entry. And that's exactly what the small chart is. It's just an entry chart. It refines that very broad stroke of a brush. It pinpoints, gives you the best spot where the market is most likely to continue. By using a smaller, faster chart for entry, you're going to be able to reduce your risk. And it's actually going to give you the best room to your profit targets because of rule number 3, putting you in where the market is most likely to continue. These 2 charts are they're an indication of who you're trading with or against. Think of the large chart as the big crowd, as the men and women with the money and the influence to create trends. They create the up or down. They establish the momentum. They react at the areas. And when you trade with a large crowd, you're going to find that typically the large crowd wins. Your small chart, your entry chart, is like a small crowd, and that small crowd fights, and they create retracements and pullbacks. But the small crowd typically fails 70 to 80% of the time. And if they're failing 70 to 80% of the time, by having those large chart advantages, by using that small chart to pinpoint where the market is most likely to continue, where the small crowd's failure is imminent, more often than not, guys, it gives you the potential to win up to 70 to 80% of the time. So remember who you're trading with or against, and understand that there are definite advantages with going with the flow. So class is the same every day. It has been for years. We're going to go over basics first. We're going to talk about advantages first. We're going to learn these rules, these trigger line and Fibonacci rules for when it's okay to trade. There is a step-by-step process. I like that it says step-by-step path to becoming a confident trader ASAP, and there's really only 2 steps in it. But man, these steps have been proven to be effective. Post your trades in class and track your real-time performance in a spreadsheet. The first part, posting in class, guys, this is really the magic of the Nexgen education. Is 15 hours live every week. You can post in the room. You can tell me what you saw. You can tell me what you did. You can show me where you did it. And you're essentially saying, hey, Mark, here's my chart. Can I get a little feedback? So we're going to click on your chart and we're going to open it up and we're going to take a look at it. And I'm going to say, man, you had a termination that reversed the market. That's your strong bottom. Both trigs are above the fib on the large chart, which means you have a clear path. There's all the momentum in the world, and you absolutely nail an entry at an area inside of triggers to get you up to the key Fibonacci area that has the potential to stop the market. And what I'm going to do is I'm going to go, holy smokes, 10K. This is the best trade ever. What a great look. Every advantage that we talk about in the first hour is there. And that's where the second piece of the puzzle comes in to becoming a confident trader ASAP. 10K is going to say, whoa, that was awesome. Let me drop it in my trade tracking sheet. Let me put it into here, and let me come back and study it tomorrow because I never want to miss that pattern. And it's actually such a nice trade that I'm going to go down here to the client trades in 10K. I'm going to steal it because it has everything that I'm about to talk about, and it's a high probability trend trade. So we're going to call it the 10K high probability trend trade. And now you guys can study it too. So we're going to learn rules. You can simulate, practice, post in the room, get the feedback. And then we're going to simplify. I'm going to hand you a plan. The plan's going to have 2 trades on it. It's going to have a high probability trend trade, which is what we're going to talk about excessively for the next 45 minutes. And then it opens the door through your understanding of those 3 advantages for what we call a medium probability trend trade. And all it's going to be is a little deviation from rules. It's going to be one of those advantages missing. And you're just going to say to yourself, wow, I don't see that advantage. Maybe I need to manage a little more assertively. 10K will be the cost, sir. Cash or credit. You got it. I'll send you a check. Just wait for it. What's crazy is now feedback costs anybody with a number in their name 10K and a penny. So you're into me for a penny at this point. Guys, I'm going to give you this plan. Your job is to just learn, what does it look like? What does your pattern look like? And that's where that spreadsheet really pays dividends. So the first tab is the basic rules. This is strong triggers and a clear path, and there's even a little bit on the entries there. Awesome, 10K. Great job. And then what it looks like when the advantages are gone. The opposite of strong is weak. Let's know what it looks like to not have that advantage. And the opposite of a clear path is a termination condition. And let's know what it looks like to have that advantage or that disadvantage. Because those red sections are the ones that tell you to pause, to wait, to embrace the 90%. The client trades, just like I stole 10K's high probability trend trade, there's about 400 pictures that I've stolen from you guys over the years. And this is just a study guide for you new users to come in, to look at it, to recognize some patterns, commit them to memory, entry sequences, management. If you're a NASDAQ junkie, there's some stuff in there. And then just patterns that repeat themselves. And you're going to see this all day long. Some of you will take the patterns and ignore them, and that's okay. Some of you will take patterns and turn them into trades, and that's amazing. Some of you will recognize patterns that tell you, well, you know what? I'm missing this advantage, but I've seen this 1,000 times. I'm willing to take the trade. And guys, everybody ends up using this software differently. And that's one of the coolest things about what we do is I'm going to hand you a plan. I'm going to give you everything you need to be successful, but you're going to find a way to do it that just speaks to you. When you look at your charts, you're going to say, oh, this is easy. This is effective. This is the one that works for me. This is going to be my trading plan. And that's where you're going to build your plan through the pictures that you take, from the feedback you receive, from the mistakes that you make. Guys, you're going to go through and you're going to drop those pictures, and you're literally going to build a trading plan. And then finally, the trade tracking sheet. I think this is the most important tab in the whole thing, because this is the one that says, what did you do? Did you have advantages, and what was the feedback? And guys, that's what this classroom is designed for. It's designed to give you feedback on everything that you do. So when you drop a picture in the room, Tell me why. Talk to me about your strong triggers. Talk to me about whether or not you had a clear path. Let me know where you entered. Let me know where you exited. And every time you post in the room, it's a private session. The first thing I'm going to do is I'm going to make sure that what you told me about your chart read is accurate, so that if you need a little help with it, we can get you a little help. Same thing with entries. Was there a way to do it with less risk? Same thing with exits. Could you have held for a bigger move, or does it make sense? But what I really want you guys to do, and this is for you, not me, write the whys. Get in the habit of writing why, because it creates a recipe. Man, I keep doing this and this is great, and here's why I did it. And once you know why, you can repeat it. And that's the key to being a successful trader, is repeating, doing the same thing every day, over and over. Not worrying about the results, focusing on the process, because the process is the rules being met. And the rules being met means that you have every advantage, you have an edge, and it's been proven to win more than it loses. So let's get going. Let's have some fun. And let's talk about the indicators that you guys are looking at. So when you opened up this morning, your charts came up, what is the confirmation of a good bottom or top? So, all right, I'm going to answer this one real quick, 10K, because I know that you said you're done for the day. So let me give you that answer really, really quickly. And I'm going to tell you that, and guys, this is 10K, thank you for this. So this classroom, the first hour, is basics. It's remedial. It's 100%. Oh, okay, right on, 10K. Well, then I'll tell you what, when I get to termination conditions, let me answer that question so we don't get ahead. But I just dropped a Word doc in there if you wanna peruse that, and then we'll go a little deeper into it. Let's talk about the indicators on the charts first, though. Cool. No, always interrupt, 10K. I thought you were leaving. I just wanted to make sure that you got your lesson before you left. Both charts have triggers. Small triggers and large triggers. Your small triggers are solid lines. Your large triggers are dashed lines. That's really about as in-depth as you need to get on your understanding. Small triggers are a fast-moving average. No matter what time frame you're looking at, they're always small triggers. It's two solid lines. When they're going up, they're green. When they're going down, they're red. Same with large triggers, but these are a slow-moving average. They react a little slower than these. And when they're green, they're going up, and when they're red, they're going down. You're going to use trigger lines to define momentum. You're going to use trigger lines to define termination conditions, 10K. They're going to play into strong tops or bottoms. And you're also going to use trigger lines, the large ones, to define entries. So know the difference between the two, because these show up in every rule. And then both charts will have areas. And areas, for all intents and purposes, are horizontal lines on a chart. They all have names. There's divergence highs, it's a magenta line. Fibonacci resistance is the red line. Yellow 1-to-1s is the yellow dotted line. Fibonacci support is the blue lines. Divergence lows are these cyan lines, which is just another flavor of blue. And then you do have the one squiggler that comes through, and that's your mid-band. And that'll be either green or magenta, depending on where price is. But all of these lines are going to come into play. So on the large chart, they're going to define where that large crowd is making decisions. On the small chart, you're going to use some of these to help you pinpoint entries. And the reality is these can create a bounce. You don't have to know the math that goes into it. You don't have to know how the programming happened. You just need to know the names, because the names come into the rules. So you're going to get this PowerPoint. You'll have all this. Let's break it down individually. 3 rules. That's it. Large chart leads the way. Large chart must have strong trigger lines, because strong trigger lines create the advantage of momentum. And I'm telling you guys, this is rule number 1 for a reason. The only way you can have strong trigger lines is if you're trading with the trend established on the large chart. So if the background is green, the trend is up. You're looking for rules to be met for high probability trend trades long. If the background is red, the trend is down. You're looking for rules to be met for high probability trend trade short. You're not just jumping in. You're saying, okay, this is the direction I need to trade. Let's go look for the rules to be met. And the only way that you can have strong triggers is if the trigger line colors match not only each other, but also the background. So in an uptrend, when the background is green, the small triggers must be green and above the large. And there needs to be space created between the two, a separation between the small and large. And in a downtrend, everything must be red, and the smalls must be below the large, and a separation. And this look, that separation, that's strong triggers. That separation means strength. It looks like a couple scissors that are open, ready to cut. And when you have that separation, the odds are favorable for the market to continue in the direction of the trend. So odds favorable momentum, guys. That's our battle cry. That's rule number one. That separation is strength, and when I have strength, the odds are favorable for it to push. Odds favorable momentum, you're going to see it annotated on charts, OFM, all day long. Odds favorable momentum is typically what it takes to break through those key Fibonacci areas. Odds favorable momentum is when we are buying and selling pullbacks on a smaller, faster chart. And guys, odds favorable momentum will even cover some of the mistakes that new users tend to make. So strength is rule number one. Let the words give you a little bit of confidence. The odds are favorable. And then when the small triggers work their way back inside of the large triggers, this is weakness. So strength and weakness. Odds are favorable for the market to continue. And guys, when you have weakness, anything can happen up or down. And you're going to see that annotated on charts, ACH. And it's cool. These little acronyms show up. And what they're going to do for you is they're going to let you know where you stand in regards to momentum. And I want to pull up this picture because I think this is a good one. So this is about, I don't know, a 4-hour period in what looks to be crude oil. And here I have separation and the market pushes down. And guys, this chart doesn't even have fibs on it. Weak triggers, anything can happen. That's right where the reversal comes from. Strong triggers, it keeps pushing up. Weak triggers, reversal. And this is why I discuss colors. Because you're going to find yourself in a position where the small and the large are different from one another in regards to color. Where the trigger lines aren't the same color as the background. And you're going to have to say to yourself, whoa, the colors don't match. My rules aren't met. And you're going to get these mismatches during times of transition when the buyers and sellers are fighting each other. Very often in between areas, and you don't have to predict. You can simply hold out and wait for that momentum to come back. Rule number one, and have that advantage. Let's see if, open up a large chart real quick. On my most current bar on this large chart, guys, does everybody see that the smalls are green, the large are green, the background's green, and I have separation between the two? Does everybody see that? That's it. That's rule number one. That's how easy it is to identify. Rule number one has nothing to do with Fibonacci, with divergence highs. Rule number one has nothing to do with these price bars. Rule number one is simply a separation between the small and large. It's a separation between the small and large. Can you guys give me a why if you're with me? That's it. That's rule number one. It's not a tough lesson. I think that's probably the easiest lesson. And then once you have momentum, you're going to be like, okay, no matter how fast this train is moving, I don't want to drive it into the side of a mountain. So we're going to make sure that there's no termination conditions. That's going to give us room to targets, and we're just going to call it a clear path. We're going to couple momentum with a clear path on the large chart. So what's a termination condition? Well, it's a Fibonacci-based indicator that may reverse the market, and we're going to compare it, the areas, to the triggers. And guys, a termination condition, know the names, is a horizontal line on the large chart. It can be a divergence high acting as resistance. It can be Fibonacci resistance acting as resistance. It can be yellow 1-to-1s acting as resistance. Or if the market's trending down, it can be a divergence low, blue Fibonacci, or yellow 1-to-1s, all behaving as support. But what I want you to say to yourself is this is where the large crowd is making decisions. This is where buyers are buying and sellers are selling and decisions are being made. And I need to make sure that I'm not trading into their decision-making process. So to identify a termination condition, and then 10K, we're going to get to strong tops and bottoms on this one too. We are going to let the large crowd get to the area. We're going to set off the decision-making process. So we're going to say price reaches resistance. Your dynamic Renko bars go up and reach Fibonacci resistance, reach a divergence high, reach a yellow 1-to-1. When price reaches resistance, the only thing that you have to do is ask yourself, where are my triggers? And if your triggers remain below, both small and large, this is a termination condition. This could do one of four things. And understand, you'll never know which one of these it's going to be. It could break, and the market could just continue up. That could be the decision. It could create a fight between buyers and sellers, and very often you'll see the market bounce and fight right at these key areas. You don't want to be a part of that fight. It could create an untradeable bounce and then continue in the direction of the trend. Who knows? And you don't want to trade into a line, get stopped out, get upset and watch it go without you. Or it could reverse the market completely. And 10K, here comes your answer. So if price reaches an area and none of your triggers break through, and this is such a key part of it, neither the small or the large get through that Fibonacci resistance. Guys, if the decision made is so impactful that the buyers lost out, the sellers took over, the market reverses, we're going to call this a strong top. And a strong top is the precursor to the highest probability trend trade you could ever take. A strong top sets you up. It's rule number one for the second trade on the plan for most of the trades that Nexgen teaches. So when we talk about a strong top or bottom, here's the picture for it. First, it's a termination condition. So you've got to be able to define that termination condition. And guys, your trigger lines, I like this picture, so I wanted to really bring this in. Make that a little bigger. Your trigger lines are like a car hitting a wall. There's two trigger lines. As long as both trigger lines don't get through the wall, your car didn't make it through the wall. Triggers didn't break the area. So the definition of a strong top or bottom is a no triggers through termination condition that reverses the market. In 10K, it has nothing to do with the fibs color. It has nothing to do with price bars, because once price reaches the area, we're done with price. The triggers will tell the story. So none get through. There's your reversal. There's your strong top. Sellers take over, create momentum. The market's screaming down. Price reaches Fibonacci support. When it reaches, the only thing you guys have to do is ask yourself, where are my triggers? If the triggers remain above Fibonacci support, above a divergence low, above yellow 1-to-1s, it's a termination condition. It could break, create a bounce, start a fight. It could reverse the market completely and become a strong bottom. And a strong bottom, while it's not a rule for the high probability trend trade, is the precursor to the highest probability trend trade you could ever take. So the simple thing is, if price reaches, triggers don't break, rule 2 is not met, no trades into the area. Sit on your hands, guys. Wait for the reaction. Remember, it could break, it could bounce, it could fight, it could reverse. You'll never know what it's going to be. They break all the time, typically with momentum. So this is what it looks like when they break. I'm going to show you both directions. Number one here, price reaches resistance. Where are my triggers? My triggers remain below. Let me just hit the brakes. Let me choose not to trade. Let me not trade into this area and hope that it breaks. Let me either let it break or reverse. And guys, an area is not considered broken until both the small and the large triggers get above the area. So once price reaches resistance, we don't care about price anymore. Triggers tell the story. This is a termination condition, but when both small and large get to the other side of resistance, resistance begins to behave as support. The area is broken, the path is clear, and the path will remain clear until you reach the next area. So with this momentum and a clear path, I'm looking for entries in that scenario. But there's an in-between. And number 2 here, notice there's a pause button. This one is stop, wait. This one is go, cat, go. Guys, the pause button. When your small triggers absolutely smash through an area, 2 to 3 points. But your large triggers, that slower moving average is kind of lollygagging and it's stuck below the area. Guys, this is what it looks like when an area has the potential to break. This is what it looks like when all of that momentum can carry it to the other side. But it's only potential. It's not a clear path, which means you can take trades. This is actually the second trade on the plan I'm giving you. This is called the 50-50 look. 50% above, 50% below. But you have to manage assertively. And guys, there's a couple red flags on this 50-50 trade that'll keep you from taking it. Because even though it's potential, it doesn't guarantee a break. So first, it's a termination. Every line is always a termination condition, even if it's for a nanosecond. Then it has the potential to break. You got to manage a little more assertively, different set of rules. But man, once small and large get below support, support behaves as resistance. Your path is clear until you hit the next area. And then you go right back to number 1. And there will be times. There will be times when your path isn't clear because the areas are stacked, because there's 3 or 4 fibs in the way. And you're going to get frustrated and you're going to get bummed out and you're going to wonder how you're ever going to make money with all those damn fibs. Guys, this is 90% of your day. 90% of your day is being patient. 90% of your day is doing nothing. And it's okay to do nothing because the futures markets exchange trillions of dollars every day. You need to make $400 a day to be in a 6-figure income. You don't have to be in every move. You don't have to be the first one in. You don't have to be the last one out, guys. You need momentum and a path, and just find a way. Find your way to capture, and you will. You most certainly will. Let's go and take a look and see if there's any truth to termination conditions. I love it when I do this. So check this out. From support, potential to break but doesn't, pulls back to support. To the divergence high, potential to break but doesn't. Support, resistance, support, just below resistance, back to support. Right off of resistance to support, big untradeable bounce to the 1-to-1s, back to support, and now the market is trading directly into a termination condition. From a strong bottom, this may have a little more potential to break. But guys, the fibs work. If you go back and do a little bit of study, you're going to learn that they work. You're going to learn to trust them. And hopefully, you'll stop trading into them, hoping that they break. That's large chart termination conditions. Is everybody good with that? If price reaches an area and the triggers don't break, just sit on your hands for a second. Guys, rule number 2 is the most broken trade, or most broken rule, because rule number 2 forces you to sit on your hands for a little bit. And they do break every now and then, but they hold more than they don't. True story. There's one more termination condition, guys, and it's 3 divergences in the same price range. This can terminate a trend, and you're going to see this on a small chart first. If you see it on a large chart, very often bigger moves the opposite direction happen. But 3 divergences is just 3 losses of momentum. That's all divergence means. So while your large chart, this 1 bar, odds favorable, momentum, potential to break, your small chart is saying, hey, we're losing momentum. We did it again. Dude, that's the 3rd time. There might be some change coming. So 3 divergences in the same price range is the only small chart termination. And all it's doing is giving you a heads up that things aren't doing what you're hoping they're going to do on the large chart. Very often you'll see 3 divergences on these 50-50 trades, that potential to break. And it's just letting you know that the potential to break is going out the window. It becomes a great red flag for you. And that's large chart, guys. Large chart leads the way. Big slow chart. Hard to see change chart. Large crowd. But if you're doing it, if you're following rules, before you ever look for an entry, you're going to have a market where the odds are favorable for it to continue in the direction of the trend. You're going to have a market where there's no key areas in the way to create a bounce or a fight that'll mess up your good time. So it's time to go look for an entry. And remember, all the entry is pinpointing where the market is most likely to continue. All your entry is pinpointing right where the small crowd is most likely to fail. And there's an awful lot of precision that goes with this rule. And so much so that you're going to use a limit order to buy or sell one of those pullbacks. Hey, good morning, Joel. You're going to use a limit order to buy or sell a pullback. And remember, a pullback is that little retracement that the small crowd creates. And you're gonna buy or sell that pullback at an area, at a fib, at a mid-band, or a yellow 1-to-1. Because the same way those key areas can create a trend-stopping bounce on the large chart, they can create a fight-stopping bounce on the small chart that gets you moving back in the direction with the large chart. But there's a key to it, and that's letting those areas be inside of triggers. Triggers show up in everything we do, and one of the things that you'll notice is that price very often pulls away from those large triggers and snaps right back to it, and then it pulls away again and it comes back to it, and it pulls away and comes back, and you see this over and over. So we've taken that and we've put the large triggers from the large chart onto your entry chart. So you have two large triggers on your small chart, and these are going to define where the retracement is most likely to go, from the top of the triggers to the bottom of the triggers, because price returns to triggers. So you're going to know where the retracement is most likely to occur by drawing that box from the lowest line to the highest line. And then you're going to say to yourself, that's pretty cool. That's a pretty big box. If you want the highest accuracy, force them to be favorable large triggers, new users. And that means that your large and synthetic are overlapping, one on top of the other, two snakes riding piggyback. And you've taken the potential correction point, the retracement zone, from both charts, and now it's in the exact same location. And then when you put a fib, a midband, or a yellow 1-to-1 in that retracement zone, this is your smallest window where the market is most likely to continue. So this is your best look. You're going to see this look a lot. That's the highest accuracy. So let's define an entry. Large chart rules are met. I can't say that enough. Large chart rules are met. You have momentum. Your path is clear. We're going to go to the small chart, and you're going to see all of these bars going up. You're going to see strong triggers. You're large, you're synthetic, you're going to see areas, and you're going to be like, oh my gosh, it's going without me. What am I going to do? Well, you're going to wait for a reversal bar. You're going to wait for the small crowd to fight. Remember, this is a pattern. This is a pattern that has been proven to win more than it loses. And guys, the reversal bar starts the entry pattern. And once you get the reversal bar, you're going to define where the retracement is most likely to go. Price tends to return to large triggers. So you have the large, you have the synthetic, from the highest line to the lowest line. This white box, it defines where that retracement is most likely to go. And the tighter these triggers are on top of each other, the smaller that box becomes. So the reversal bar isn't your entry. It signals the beginning of the fight, the beginning of the retracement. The trigger lines aren't even your entry. They just show you where that fight's most likely to go. You need areas. You need an area inside of triggers, at least one, guys. And areas can be fibs, they can be mid-bands, they can be yellow 1-to-1s. Areas are not pink 1-to-1s. Those are very small swing 1-to-1s. Areas are not divergence highs and lows. Areas are fibs, mid-bands, and yellow 1-to-1s. But there's that key word, inside of triggers, inside of the retracement zone. And guys, this box, from the highest support to the lowest support inside of triggers, this defines where the bounce is most likely to happen to continue with the trend. This defines where the small crowd is most likely to fail. Guys, this is the magic. You're going to study it, you're going to see it, you're going to trust it, and you're going to activate a limit order 2 ticks above that highest point of support, and you're going to dare the small crowd to push down there. And at this point, you've done all you can do. You've insisted on momentum because your money's worth a market likely to continue in the direction you're trading. You've insisted on a clear path because your study has shown you that more often than not, they can stop the market and create an untradeable bounce. You have defined exactly where the trend is most likely to continue, and you have activated your limit order. And now it's up to the market. And if they get to you, well, you're in that position with all those advantages, guys. And this is the look that typically wins 70 to 80% of the time. This is the look that creates confidence through that memory of success. Guys, this is your foundation trade that teaches you to recognize advantages and to pinpoint where the market is most likely to continue. And through that study, through understanding where the market is most likely to continue, you begin to recognize where the market shouldn't go. So everything says up, the trend is strong, the momentum is great, the path is clear, and you wait for the reversal bar. And the reversal bar is not your entry. The reversal bar says, let's go define where the retracement is most likely to go from the highest line of the triggers to the lowest line of the triggers. And you're going to remind yourself the trigger lines are not my entry. Then you're going to look inside for areas, fibs, midbands, yellow 1-to-1s, and you're going to create what I call the window of opportunity. The window, the range where the market is most likely to bounce and continue with the trend. And sometimes it's a tick wide, and sometimes it's 5 ticks wide, 10 ticks wide. Depends on your trigger lines, depends on the areas. But you're going to have the courage to activate a limit order 2 ticks above it. And you're going to understand that if the market is most likely to retrace to the bottom of the triggers, if the market is most likely to bounce at the areas inside of triggers, then any line beyond the triggers, what I call the wrong side of the triggers, this is not a part of the entry equation, guys. This is where the advantage of rule number 3 is no longer present. And the same is true on shorts. Reversal bar starts the fight. You define where the fight is most likely to go with the trigger lines, and you define where the fight is most likely to end and to bounce in the continuation of the trend. Activate a limit order 2 ticks below, and anything on the wrong side of the triggers, anything beyond the retracement zone, anything beyond the areas most likely to create a bounce, guys, this is where the market shouldn't go. This is not a part of your window of opportunity. The advantage of rule number 3 is gone. Can you guys give me a why if you're with me? Because once you define where the market is likely to continue, guys, once you understand where the market shouldn't go, that's actually going to be your first stop placement. And I'm going to tell you, if my large chart rules are met, if I get a reversal bar, if I enter at the area inside of favorable large triggers, I'm going to force that small chart to do some work. I'm going to put my stop 4 or 5 ticks beyond those triggers, beyond the retracement, beyond the bounce point. And I'm going to say, the only way I'm getting out of this trade is if they come and get me. And guys, 20 to 30% of the time they will. That's okay, Andy. We won't tell them you forgot. You might still be able to do it. We'll be fine. I can see your charts. We're good. And guys, great entries create very manageable trades. Great entries lower risk. Great entries increase the distance to profits. And once you can pinpoint where the market is most likely to continue, you learn that language where the market should not go. And guys, you're going to use that for management. But you've got to learn the pattern. Got to learn the pattern. So, if then, good morning, Sid. If I have strong triggers, then I'll look for a clear path. And if price hasn't reached trouble and it's cleared the previous, then I will go look for my entry. I'm done with the large chart. And guys, your market is trading all the way up here, maybe even there, when it's time to look for an entry. And a lot of you are going to say, but Mark, there's only room to make $80 to trouble. That's it. $80 isn't enough money. And then you're going to remember, oh yeah, I'm not getting in at the top. I'm waiting for a reversal bar. And at the time of the reversal bar, I'm pinpointing where the market is most likely to continue. And my entry is just above that area. So that $80 turns into about $300 worth of potential. And since you know where your stop goes, by getting in low at the pullback at the areas, you've reduced risk. You've maximized your profit potential. And guys, this is your pattern. This is the pattern that you need to study. This is the pattern that you need to learn. Strong triggers, clear path, wait for the pullback. You can go back historically and circle these tails on a large chart when the rules are met. And if it lines up with an area inside of favorable large triggers, guys, you have a trade. So that one was right into a termination condition. That one didn't fit the rules. Let's see if we can find one of those tails with a clear path. And they're going to mess with me this morning. That's crude oil. Let's go to the S&P. I think it's moving just a little bit more. And they're going to mess with me too. There's a pretty good look. And I think this was this morning. Does everybody see strong triggers? And we're right about there when this trade happens. Strong triggers, smalls above the large, larger wide, the separation is there. Price has not reached Fibonacci resistance, and we have cleared the previous resistance. Guys, rules 1 and 2 are met. So let's go on our small chart. Let's go see if we can find that trigger line, or that circle. There it is. And look at that. Rule number 3 wasn't met. That's not an area inside of favorable large triggers. And guys, that's going to happen sometimes. That one didn't fit the rules. That's not my pattern. So I'll back up and I'll say, all right, momentum potential to break. There's the tail. Let's go look at it. And that one pulled right back to support, right inside of triggers. And guys, there's your pattern. Better data, doesn't matter what I would do. As a brand new user, as a rule follower, as someone that wants the highest chance of success, no, it doesn't fit my rules. How's that for an answer? Rules not met, no trade, no matter what I want to have happen. Because that is my path to success, is to be consistent in everything I do and leave my opinions out of the mix. Better dad, does that mean that one day that might not be my entry? Well, one day it might be. One day I might say this chart is perfect, this chart is not. If I get a reversal bar in the direction of my trend, hell yeah, I'll take that trade and hope that it runs up to fib. So better dad, you're absolutely right. But for the brand new user, it's better to not have a gray area. It's better to leave it black and white. Because what happens is you'll start finding ways to break your rules because it'll allow you to be active. It'll allow you to be in the market. You're going to be like, man, I haven't taken a trade in 17 minutes. I know that I don't have the best momentum, but I'm going to trade anyway because I'm not getting paid. Guys, billions every day. That's all of today's movement. The next trade is coming. I can't stress that enough. The next trade is coming. I've only seen the market hit zero once, and that was crude oil a few years back. Woo, that's kind of big. So how do you get to where you want to be? I'm going to give you all of this stuff, guys. This is the easiest way. It's taking pictures. You'll get more out of picture taking than you will frantic trading as a brand new user. So I put this together to help you guys get to where you want to be. Chart reading 101, guys. The goal is that you look at your large chart, that you commit to large chart advantages before you look for an entry. And this is the core. This is the foundation. This is the beginning. This is the one that sets you up and gives you the skills to find the next trade. So take 25 pictures each and take the time to explain why the rules are met on the chart. Get comfortable with annotating charts. So when you take a picture of strong triggers, you should be able to type on the chart with an arrow at those triggers and say, Smalls above the large. Colors are all green. Separation means strength. Rule number 1 met. Odds favorable momentum. Put it all in there, because what you're doing is you're creating a correlation with what your brain sees and what it means to you. And the stronger that connection is, the quicker you're going to read your charts and get on to the next one. Do I have a clear path? Let me go through the rules in my head. Small and large are above the area. I haven't reached the next area. My path is clear. Rule number 2 is met. And when you do that, that correlation, you execute chart reads, I mean, in a fraction of a second. So take those pictures and go to the basic rules and fill this thing up, guys. 25 pictures each, and that's just a start. I've already put 50 pictures of strong triggers. We've got, good Lord, 80 pictures of termination conditions. You've got over 20 pictures of weak triggers. Clear path. I mean, I've gotten you started. This is going to make you a chart reader, and it's going to make you a chart reader fast. You'll be able to open a large chart and watch this. I have momentum, I don't have a clear path. That's how long it takes. And then you've got to convince your brain that since you don't have a clear path, it's okay to not take the trade. Literally will take you 2 to 3 seconds to do your chart read with a little bit of study. And I'm going to tell you right now, and it's funny, my brother told me this years ago. He goes, if it takes you more than 10 seconds to decide if you have a trade, you're looking for a way to break your rules. Anyone else feel that? Identify with that? If it takes you more than 10 seconds, once you're comfortable with your rules, you're finding a way to break them, is what you're doing. You're looking for a way to break them. I think it's important to know that. So learn to read your large chart, guys. That's such a big part of it. And then this is a high probability trend trade checklist. And 10K, there's that picture again. Your high probability trend trade checklist. This is the best of the best way to take the high probability trend trade. It's not the only way, and I can't stress that enough, guys. You're going to find variations, like Better Dad said. Could I get into that with a confirmation bar? You can do whatever you want. I teach the best of the best. I go back to the best of the best every day because I want you guys to have that confidence through success. Is the market coming from a strong top or bottom? Not mandatory. But it increases warm fuzzies, guys. It creates the likelihood of success. So absolutely no triggers through the termination condition. It makes it a termination condition first. If that termination condition reverses the market, well, then it's a strong top or bottom. And guys, that is rule number 1 for the second trade on the plan I'm going to give you. Make sure that you know it. It asks if you have strong triggers, both charts. Strength is the same look. Separation between the triggers has nothing to do with fibs, has nothing to do with any of those areas, doesn't even have anything to do with the price bars, guys. When the triggers are separated, you had strength. When they're together, you have weakness. Rule not met. Termination conditions. Know the difference between the 3 looks, guys. The first one should be absolutely no trades for the new user. I refuse to trade into an area that could stop my forward progress. The second one, okay, this one has potential, but my path isn't clear. I'm going to insist on momentum in the perfect entry. I'm not going to sacrifice my other advantages. I'm going to manage assertively. This will be your second trade and probably the majority of your trades. But that clear path with momentum, guys, you better be chomping at the bit, looking for your entry, and then define your entries. So the second page of this one, this is the checklist. Same thing, just without the pictures. You can print this one out, put it on your desktop. And I'm going to tell you guys, nobody in the history of this checklist has ever done worse than 70%. I've had engineers put it through the ringer, and it's right somewhere around the 83% range. It's boring. How many high probability trend trades do you get in a day? I don't know. On a good day, you might get 7. But the reality is it might be 3 to 4. That's it. That's why you learn this one, so you can find that medium probability trade. But be able to check yes to all of them, guys. It's going to pay huge dividends. And then I'm going to take you to the KISS plan. And you guys will get all of this. I promised you everything you need to be successful. This is the KISS plan, the Keep It Simple Sunshine plan, because I'm not allowed to call you stupid or Bob, you know what I can't call you. I love it. I chuckle every time I see your picture and I read that. Guys, this is a stepping stone. This isn't the only trade. This is the one that keeps you focused on the best of the best, guys. It's designed to optimize your chances of success with the high probability trend trade. This is designed to get you so comfortable and focused on learning how to follow rules, on having advantages, and then through simulation, study, class feedback, and continuous practice, you will create your own plan. You'll begin to see things. You'll recognize patterns. You'll take chances. You'll manage differently, guys. But this is the foundation. Learn how to do this great before you look for more. You'll create your own plan based on your experience reading the indicators. What happens is, and I'm gonna share this with you guys, is this plan. I've had people follow it to the letter and get funded in prop firms in their first 30 days. And then we all have this desire for more. It's human nature. I realize this one wins 70 to 80% of the time. I know it optimizes my chances of success. I know it's very pragmatic and easy to execute. It's not difficult to learn, but I saw Bob do something different. I saw Pete do something different. Alex came in here and took a different trade. And well, if Andy can take that trade, then damn it, I need to add to my plan because now I'm missing out. And guys, I'm telling you right now, if you focus on the best, it becomes easy. And there's two things that you have to know before you ever enter the market. You have to know why you're going to enter, and your entry should be rules-based. Your entry should be a pattern that's proven to win more than it loses. So when you post in the room, guys, all we're going to do is go over your ability to recognize these advantages. Lonnie has to leave, so we're going to go over Lonnie's chart together. We're going to talk about the advantages. We're going to talk about the chart read, and we're going to see what happened and how you did it. So Lonnie, not a strong bottom, brother. Your triggers broke through everything. Not a strong bottom. But that's okay. You did have odds favorable momentum. There's no such thing as a medium strong trigger. So it's either strong or it's weak. Guys, the more variables you create, the more difficult it is to follow your plan. Does that make sense, Lonnie? It's not medium strong, it's separation. You're good. Until they work their way back inside, it's strength. But it's only 50-50. It's the potential to break. So you tried to just jump into the market. You tried to ride that wave of momentum, and that trouble spot created a bounce. Nice exit. I love that trade, Lonnie. You took a shot at that chili dog, but you broke the rule. You didn't let price get to the other side of trouble. And then it came back, and it turned into the perfect trend trade. Those are some pretty quick profits. But beautiful. Lonnie, it's perfect. You had momentum, the potential to break, strong triggers, the perfect entry, and because it's not high probability, you managed assertively. I love everything about this. Nicely done. And then it came back to the area of support inside of favorable large triggers. Large chart advantages never changed and actually turned into another trend trade for you if you chose to take it again. Great job, Lonnie. But you have to know why. And guys, if you ever have to leave early, let me know. We'll review your charts. You have to know why you're going to enter. And the generic answer is because my rules are met. Why? Because my rules describe a pattern that has been proven to win more than it loses. That's it. Which means that it does lose. I will take losers, but I will take more winners than losers if I can force myself to be consistent, to never miss the entry, to never talk myself out of the entry. And guys, it helps remove the emotions. And I'm going to tell you, there's going to be times where you see the perfect trade and you talk yourself out of it. And there's going to be times where you see the not perfect trade and you talk yourself into it. But the goal on Sim as a brand new user is that consistency. Rules always met. And then you have to know why you're going to exit. Um, this is the fun one for most of us. Because exits are either taken at profit targets, predetermined or key areas, whatever, or, and here's the or, and the or is the one that gets new users, when the advantages that you had to enter the trade have gone away before you reach those targets. So for example, if I have odds favorable momentum, if I have a clear path, if I take the entry in an area inside of favorable large triggers and it goes beyond the triggers, 4 to 5 ticks, my advantage is gone. My exit is taken, even though it's a loser. Losers are okay, guys. Losers aren't failure. They're a cost of doing business. Or perhaps I enter that high probability trend trade in 3 divergences print. And I say, egads and little fishes, my advantages are gone. I need to exit this trade. And guys, willing to exit a trade because your advantage is gone is what keeps you from taking those huge losers that kill accounts more often than not. And with this KISS plan is designed to put you in with the highest probability of victory. And then you've got to manage it. And the management in the KISS plan is every bit as if then, emotionless, pragmatic, whatever you want to call it, as the entry. And the KISS management is based on 2 contracts. The first contract is focused on getting you paid. The second contract is focused on developing trust. Remember, you're on simulator. Don't worry about the result. Focus on the execution. The management plan in the KISS plan, guys, it's designed to help you understand and trust stop placement, putting your stops where the market shouldn't go. But more importantly, it's designed to get you paid, to get you comfortable exiting positions. Learning that small victories compound and build up. So you will create your own management plan. There's no doubt in my mind. And it'll be based on your experience reading the indicators. But until you can do that, guys, this is an outstanding way to pull a lot of the emotion out of trading because it is nothing more than if-then. So if the entry is 2 ticks below resistance inside of triggers, then the initial stop is 4 to 5 ticks beyond the triggers, guys. This is where the market should not go. In this particular picture, that's $150 per contract. That's the intelligent stop. That's where the market should not go. You're going to know your risk before you ever enter the trade because you're going to say, this is where I'm getting in, this is where my stop goes before the small crowd ever gets there. And you've got to learn to accept risk. You've got to be okay with risk. If Sun Tzu said, if you don't put yourself in the kill zone, you can never be victorious in battle. And that's kind of what this is. But we get out of the fight spot. If you decide that 150 is too much, I'll give it 50. You're in the retracement zone, guys. You're at those areas inside of triggers. You're at an entry. That's not an exit. So be willing to accept it. And remember, you're on simulator. Who cares? Let it play out. Your targets are predetermined, guys. $100 and $200. Keep them in play. If you don't get stopped out, if it's not part of that 20 to 30%, if you're not providing the cost of doing business, guys, you're going to get a reversal bar in the direction of your trade. And you're going to redefine where the market should not go. And your new stop will be 2 ticks above that reversal bar or 2 ticks below for a long trade. And you've gone from $150 of risk to $30 per contract. So from 300 total down to 60 because now the market has confirmed that it has bounced off the area where it's most likely to bounce. It has confirmed that it's moving in the direction of the trend, of the momentum, of the clear path. Guys, if you could still get stopped out. It doesn't guarantee a winner, but those are tiny little losers. If you don't get stopped out, that means that it's going to your first target, predetermined at $100. And if price reaches your first target, one contract is automatically pulled off. And those funds go into your account, guys. You're successful. That's a win. And there's a lot of you that don't feel like $100 is worth your time, but guys, $100 is awesome. It's a base hit. And it only takes 4 base hits to hit a home run. But you're going to get paid. And your new stop movement is going to be break even. You're going to have zero risk on this trade. And this is where the second contract creates trust. Break even probably isn't the best option. But for the brand new user, this is an amazing option because it's going to keep you in the trade. And you have no risk and you've made money. And we forget very often, getting focused on that smaller, faster chart, that the only reason we entered the trade in the first place was because we have a market that's going down with odds favorable of it continuing down, and there's nothing in the way to create a bounce. And guys, more often than not, your trade's gonna hit $200 from your great entry. And even if it doesn't, you still made money on a trade that failed. But your second target, if it's hit, that's a $300 trade, guys. And you're out, and it doesn't matter what happens next because you just made $300. And guys, the KISS plan is designed to get you paid. It's designed to get you comfortably paid. $300 a day is a $75,000 year over the course of a trading year. Throw in another one that goes to break even, it's six figures, guys. The key is that you're reaching daily profits consistently. That every day you're making money, and not all the money, not chasing all the money. You're taking what the market gives you instead of demanding that the market give you what you think you deserve. And as you grow and you learn and you understand more, guys, the potential for higher rewards, it just presents itself. Pete showed us in the room Friday, he was up $18,000 on the day. And Pete has done the time to study, and he's got a plan, and it's an amazing plan. And guys, it's not uncommon to see Nexgen users doing that. If you spend any time in Traders Chat, you'll see guys making tens of thousands of dollars every day with the software because they found their way. And instead of taking more trades, they're taking better trades with more contracts. And that's a big part of it. And once you understand the very basic, the foundation, it opens the door for the second trade, the 50-50 trade. And this is a way to optimize your chances of success with it. But you have to know the first trade's rules to do it because it's different rules for entry. It's different rules for management. So let me give you the zip file. This is called Everything You Need, guys. That's the Everything You Need file. And let me give you my spreadsheet as well because it's updated all the time. And inside of the Everything You Need file is the chart reading 101, building a foundation, guys. Taking a lot of pictures. Inside of there is the high probability trend trade checklist with all the pictures. Inside of there is the KISS plan, optimizing your chances of success. It's the daily goals, I think, is in there. The PowerPoint that I used to teach. And then this one's in there as well. And this is everything that we have talked about in the last hour. This is the Trend Trade Simple. This is everything condensed into 2 pages. So for you newer users, it reminds you what we do and why. 3 rules, 2 charts, understanding the core. Here's your rules, where to find them. There's your indicators. And then it just goes through the high probability trend trade, everything we've talked about, every picture that you've seen, all the way down to how to study. So take this one and commit it to memory and learn how to recognize it and understand that you don't have to hit home runs. And what you'll find is that your path is easier. You now have rules. They've been broken down individually. You know exactly where to find them, what they look like, how to study them. You have a place to study them. Hell, you even have other people's trades to look at to recognize these patterns. You have the ability to simulate, to post in this room, to get feedback on everything that you do. And guys, don't hide losers from me. Because losers are where the lessons come in. You've got to take losers on Simulator, because that's how you identify what's going to cause trouble for you later down the line. Keep it simple. Keep it focused. I see it all the time. people like, well, okay, this is good. I need more. I need more. I need more markets. I need more charts. I need more trades, Mark. Keep it coming. I need more. And then about 30 days later, hey, you know what, Mark? I just went back to the high probability trend trade. Mark, I went back to the KISS plan. It turns out I was chasing everything and finding nothing. That's how the KISS plan came to be. Was somebody calling me and they had like 7 trades and they didn't have any rules. Less is more, guys. You don't need everything. You just need the best a couple times a day. So, better dad, but it's so common. Everybody does it. Everybody does it. I'm gonna tell a story and then I'm gonna take a break. So, guys, in my previous life, I was in the service industry. I was a GM for a really popular restaurant in Texas. It expanded all through the southeastern coast. Um, and my job, believe it or not, was to train new managers. I had people fly into me from all over. I'm in Florida, Chicago, up and down Carolinas, Colorado, and they all came to me to learn systems and routines. Believe it or not, I'm pretty good with that stuff. And everybody that I got one of these. Hey, here's your checklist. This is exactly how to do it, exactly where to do it, exactly what it looks like. This is going to guarantee you success. If you can just follow this, then every one of my managers in training looked like a rock star, and that's why they sent them to me. And they would follow this checklist, and they would demand on doing everything right for about 30 days. And then the 30-day stupid hits, and that's what I called it. And I know you're not supposed to call people stupid. I never would, but I'll tell you that your actions are pretty freaking stupid. Mine too. Because we know that this creates success. We know that it presents more wins than losses. We learn how to manage it so that we can make money consistently every day, and then we're just not happy with it. And we abandon everything that brings us success. We abandon every lesson and everything, and we have to do it our way, and that's human nature. And guys, that's going to be a part of your learning curve. Is you're gonna follow rules and find success, and then you're going to try to break those rules to find more success. And what you're going to realize is that success doesn't come from your desire to make money. Success comes from your ability to follow patterns. It comes from your ability to follow rules, to commit to doing nothing when there's absolutely nothing to do. So when you stray, understand that it's normal, but also understand that if you're posting in my room, I'm gonna try to bump you back into play. I'm gonna try to get you back into position where you need to be. Sorry, my NinjaTrader crashed. So I'm gonna bring it back up, and we'll focus on the best of the best, the way we do. So as we get into the second hour, that's exactly what we're gonna do. I'm not gonna judge you on your trades, guys. I'm not gonna ever tell you that you did it wrong. But for the sake of the classroom, I will discuss momentum, path, and entry on every chart that's presented. I will look at the entry and I'll talk about management. So show me your trades from start to finish. And what you're going to recognize is that there's a lot of ways to use this software. There's a lot of trades that present themselves, and they might not be your trades. Focus on your path. Because once you find your path, once you can say these 3 advantages out loud, then the door's open for everything else. So I'm going to walk away. I'm going to take 5 minutes. When I come back, it's 100% on you guys. It's 100% your charts, your questions, your needs. I'm going to open up crude oil as well. So I'll be back in 5. Go stretch your legs, and we will regroup in just a minute. Back in 5. All right, y'all, here we go. Here we go, second hour. So I'm gonna scroll up to the top. We're gonna start looking at some pictures and we're gonna see what's going on in the wonderful world of you guys. So Bob was posting yesterday. Bob's like, you know what, Mark? I am always on duty. Let me give you some posts to talk about Monday morning. And here we go. Remember, guys, I'm not here to be the trade police. Oh, thanks, Andy. I appreciate that. I am not here to be the trade police. So, strong bottom on the pivot stop out. And Andy, I have to disagree with you. And I know you guys hate it when I do this. Oh, I'm sorry, not Andy, Bob. So, guys, this is not a pivot stop out. And here's a good lesson. So, let's go turn it into a lesson. And this is why you guys post in the room so that we can. Strong bottom on the pivot stop out. This is why we annotate it. Lets me know what your chart read is. And then your chart read lets me know if you need a little insight. And we absolutely do on this one. So the difference between a pivot and a pivot stop out, guys. And I've got these little snippets that I like to write up. So this is what we're working off of here. And this is one of the most misunderstood concepts of termination conditions. So a pivot, we're going to define it, is nothing more than up and down, down to up. That's it. It's a V. It doesn't have to be in an area. It just means that the market changed direction. That's a pivot. If there's a loss of momentum at the pivot, you're going to see one of these divergence lines. Magenta from a high, cyan from a low. You don't even know that this loss of momentum is there until like the third bar. And this on itself, not a termination condition. It's just a loss of momentum. But a pivot stop out is when that loss of momentum becomes a termination condition. So over here, I get that divergence, that loss of momentum. And then over here, this is what creates the pivot stop out. Price trades above the divergence line and then back below. And what's happening in this instance, I like to create stories for the wise. The buyers are in control and the sellers took over and stole their momentum. That's what creates the pink line. And this line is like a line in the sand. This is where the seller said, no more buyers, we're stealing your momentum, go the other direction. And the buyers said, no, we really want to go up. And then there's that line in the sand. And the sellers all say, do we let them have it or do we kill them? Let's let them think they have it. And they let the buyers get about 4 or 5 ticks above. And then the sellers go, we were just messing with you. We're going to stop you out and head the other way. And it's that pivot stop out that's so powerful. There's your pivot. Absolutely, Bob. It has to become a termination. Go below it, then back above. Because this is your pivot. This is where the buyers stopped out all the sellers. That's where the pivot stop out phrase comes from. And then it rockets the other direction. So yours didn't quite make it. Second higher divergence is a good look, but it's technically not a strong bottom. Momentum is amazing. I like it. And I know that you were waiting for it. And then you call it a 50-50 look. Are you referring to the midband? A lot of great lessons on this one. Yeah, so 50-50 means that an area has the potential to break, right? So let's go back and let's do another lesson. When we talk about termination conditions, the midband makes the list. But the only time a midband is ever considered a termination condition is if the large triggers are a full bar away. Do you guys remember that idea that price pulls back to the large triggers? And there it is right there. The only time a midband behaves as a termination condition is if the large triggers are a full bar away, because it's bouncy. And price returns to large triggers, and when you combine the two, that's what we call the gap theory. And in the gap between the midband and the large triggers with price up here, it's more likely to suck back. See if we can find another example of it. Da, da, da. Well, there we go. There's another one right there, Bob. That's when the mid-band, excuse me, is a termination condition. Bum, bum, bum. So you actually have odds favorable momentum, and you had a clear path all the way until you reached Fibonacci resistance. And then when you reached Fibonacci resistance, you said divergence, no trade. But what you should have said is termination condition, right? Price reached resistance, triggers are below, even with the momentum, there's nothing to do. And your small chart was doing its best to talk you into it. Your small chart was saying, come on, Bob. Look at the momentum. Come on, Bob. Look at the areas inside of triggers. Just take it. Take the trade, right? Come on, man. And Bob, in his infinite wisdom, said, you know what? It could break. But I've done a little bit of study, and I know that trading into areas loses more than it wins. And you may find some patterns that create that advantage, right? But coming from a weak bottom, that's not it. So great job. Way to hold off, Bob. A lot of good lessons in that picture. Now we have the strong bottom. Now we have the pivot stop out. Now you have odds favorable. Potential to break. No divergence. Strong triggers. Perfect entry. One contract off. Perfect entry again. One contract off. Two contracts off. Perfect entry again. And run it up. And Bob, I remember we talked about this in the room. And you took that lesson and you executed it perfectly. Isn't that awesome? Get into, get out one, add it back on, take it back off. Add it back on, take it back off. Man. Rock star. All right. Weak top, odds favorable, 50-50 means it has the potential to break. No divergence, strong triggers. You get in, you get paid. Nicely done, Bob. Another nice one. Strong top. Okay, so you say a few ticks away. I like this. Can I talk about why it's not? And I think you guys will dig this. Close is cool, right? So Bob, close works on fibs. Because fibs are tens of thousands of calculations. All of these Fibonacci measurements that created these Fibonacci lines. So a tick or two below, a tick or two above, right? It's an area, 100%. The thing about these divergences, Bob, is that is an exact number. That is the precise moment in time where the sellers took over and stole momentum. So these lines are exact. These yellow 1-to-1s are exact. But fibs are areas. So I still love it though. This could have been a little bit of overrun. It looks like you had 3 divergences up top. Just a little bit of overrun. Odds favorable, potential to break, perfect entry, great exit. And you said, man, this is amazing. I know where my stop should go. I'll hold through 2 divergences, and sure enough, really nicely done. Great job, Bob. All that study's paying off. All right, 50-50 trade from a weak top, low probability, momentum on charts, and small charts. So, Bob, you're calling this a 50-50 trade, but it's not, is it? What kind of trade is this, Bob? I think you know. You're writing the rules for the chili dog on here. No. There's no pullback. So the rules that you wrote, when price bar clears divergence, When price clears the problem areas, if I have odds favorable momentum both charts, I'll just jump the fudge in. So that's Ron's trade. That's the chili dog trade. And guys, this is one of the reasons why when you start looking for more, make sure that you know the rules. Make sure that you're not creating this crazy love child between a 50-50 and a chili dog, or a momentum trade and an HVA trade, guys, because you're going to manage them differently. And this is perfect execution on the chili dog. You let price get away from the decision-making zone. You have odds favorable momentum on both charts, and you just ride that wave of momentum down. So Joel, the chili dog was designed by Ron C. in this classroom. And the whole premise is he learned the high probability trend trade. And what he realized is that when you couple momentum and clear path, when you accept that decisions are made at key areas, you can take advantage of that look. You can take advantage of that momentum, getting away from the decision-making points. And that's exactly what this is. It forces all of your price action away. It's not a clear path yet. This is like the precursor to the clear path. But with the momentum, it's a quick profit trade. Joel, it's not a Nexgen trade. Nexgen had nothing to do with it. Ron C. put it together, recognizing this pattern when he learned the high probability trend trade. He started presenting it in class, and the masses are jumping on it because it's hard to stop a market with that much momentum. Strong bottom, odds favorable, clear path, 3 divergences, no trade. I agree 100%. And sometimes you just gotta let it happen, Bob. And I like that you went back and didn't hold that one. Nicely done. All right, we're going to the next one. All right, let's look at Wayne's. Wayne says, check it out, Mark. I've got odds favorable. Let me figure out which one we're looking at here. Not a clear path, though. I have to disagree on the clear path, Wayne. Because price reached Fibonacci resistance, all of your triggers were below. So technically, you're trading right into an area that could stop the market. But let's go through and look at the whole thing. With all that momentum, and even your small chart and your range chart are strong triggers, no divergence. Well, that's like saying, Wayne, I drove my car into a brick wall, but I bounced back 10 feet off that brick wall. I've got plenty of room before I hit that brick wall. Does that make sense? What Wayne is saying is, I'm choosing to take this trade, and I know that that fib can be trouble. So by choosing to take this trade, I've got room back to trouble. So I'm with you, Wayne, but I want to make sure that the people behind us understand that in the way it's taught in this room, it's not a clear path. But Wayne says with momentum, with everything up on every chart, I'll still take this trade, understanding that I'm not trading directly into the fib. I'm giving myself room for the retest. And you did it perfect. And your exit is perfect. Great job. And then this one is just momentum and potential, and you tried to go long and it didn't work, and you tried to go long and it did work, and then not sure. See a lot of longs, and then you turned it around and went short. When you traded with everything, you made money. When you traded against everything, you lost money. There might be a lesson in there. And then with all this momentum and nothing in the way, there's your chili dog. Boom, quick little $100 hit. Love it. And then when the momentum fades on the chili dog, you hold it, turns into a trend trade. And then it pulls back again, and it looks like it's still a trend trade, Wayne. So if you're going to take a trade, and I'm not telling you what to do, and we'll just block out this one. If the whole reason I enter a trade is momentum, it stands to reason that a loss of momentum may be a reason for exit. Not telling you what to do. This was perfect. 100%. In, out, ride the momentum. It was great. Oh, you were out of the room to manage properly? Right on. And you said you're on sim because you're getting your mojo back. Turned into the perfect trend trade. I love it. Could have even gone again there. And then you get managed out of this one. And I thought this was kind of cool. Is it never got outside of those large triggers. And your trade was done by then, but I noticed this and it's pretty cool. And this is why that stop placement is a big part for trend trades. Understanding where the market shouldn't go. If you chose to take the trend trade, it looks like it would have kept you in to go with. But yeah, if you're not there to manage, it's hard to manage. But the lesson for you kids that are just jumping in with momentum, once you get a close on the wrong side of the triggers, that advantage is gone. And you have to choose whether or not you're going to exit with a loss of advantage, or if you want to hold it and hope it turns into a trend trade. But yeah, if you're not there, I mean, what can you do? And then this is just worth looking at. Gosh, that's gorgeous. I hope you guys had such a good time. It's so good to get away and unwind a little bit. Is that you flying? Would have gotten out with the divergence. Right on. Were you flying down there? No, Frontier? God, that's pretty. So pretty. Guys, always share your vacation pictures with me. I appreciate them. All right, Bob. Bob says, Mark, I have a strong bottom. I have the best momentum ever. Mid-band is not a termination because the large triggers aren't a full bar away. Has the potential to break. No divergence. Perfect entry. Easy money. Bob, really well done. It's within the range of your plane, though? Right on. Can you do that? Can you fly down to... I don't know aviation rules. Like, could you just go, man, let's go to a nice beach and fly to it? That would be awesome. My wife keeps talking about wanting to learn to fly. I may have to get her going on that, so she can fly me to paradise every now and then. All right. 10K, we looked at yours. Better, Dad. Termination, strong bottom, everything up, odds favorable, perfect entries, easy money. I already stole that one for my spreadsheet. Such a great trade, 10K. All right, Sid, let's see what we have, my friend. Ninja crashed a few times. Yeah, mine did once this morning. All right, Sid. Entered with a clear path of momentum going up. Exited when momentum weakened. So, Sid, you had a termination. It reversed the market. It created momentum. And you took one of those little momentum-based trades and just said, man, I'm going to ride the momentum from a termination. Easy money. I like this one, Sid. Great job. Great patience. Not hoping it goes up. Letting your small chart tell you change is coming. And then just, man, Really nice execution. Not at all a high probability trend trade. What a great way to take advantage of those termination conditions. Nice work. And then, was this Cav? This was Cav. Triggers never broke above the fib. Triggers roll down and wide. So termination creates a reversal. There's your strong top. All the momentum in the world. And this is just the same thing Sid did the other direction. From the termination, get that odds favorable, and just ride that thing down to trouble. I mean, beautiful, both of you guys. Making money both directions. How cool is that? Better dad, strong top, strong triggers. You get in back here. You see the gap theory, better dad? See that huge gap back to the large triggers? Does everybody see that? Price got to the mid-band, large triggers were days away, and it closes the gap. And that's why this one, great job on the fast management. And then it went back and closed the gap to those triggers. And there's your confirmation bar, still in the zone. Better dad, that's awesome. You let the small triggers roll, but the expectations are the same. Beautiful trading. Great trading. And I love that you're like, let me just follow my plan. Let me not get ahead of myself. But I think the only thing, so your quick management on this one is outstanding because it closes the gap. And then once it closes the gap, confirmation is great. You get in a little bit late. You even let the small triggers roll, get below the large. And it's just easy money with this look. Really great trade, better dad. And that was the first one. So you get in, and you just have to recognize that gap theory and manage aggressively. So great job. Nicely done on both of those. And then Pete. Yeah, I knew it. Strong bottom. And look at that. You and Sid took the exact same trade, riding that momentum. And then it hits the fib. And Pete, and guys, this is one of the things that happens when you recognize patterns. Pete and I were talking about this weekend, actually. Because of the strong bottom, because of the momentum, because of a well-defined entry with room to get back to trouble, Pete says, man, this is one of those trades where I've done enough research. I've studied enough. I've taken enough pictures. I've won enough, I've lost enough, I've created an understanding of whether or not I can get away with this one. And Pete gets away with it better than anybody because of the strong bottom, because of the momentum, because of the strong triggers, because of the low risk. Pete's willing to take a shot back to the fib. And new users, I'm obligated to say to you, trading right into a termination condition. But Pete and Wayne have the same idea. With so many things working for the trade, I have room to get back to trouble. And guys, that's where a lot of you are going to be headed one day. But until you're consistent with the basics, it's okay to sit on the sidelines for these. Nice one, Pete. I always feel like I beat you guys up sometimes. Oh, you're trading into a termination condition. But the reality is, you guys can do whatever you want. And I notice which of you do it because you hope it breaks and which ones of you do it because you've studied it. All right, Andy. Everything says down, strong trending market, and you say, I'm going to sell the mid-band till it doesn't work. Perfect trade, Andy. Absolutely perfect execution in a strong trending market. Better Dad's walking the dog, so I'll skip his. 10K. Was willing to go counter here, but no divergence. My rules, divergence, print. strong, gone below or above, pull back to the open or rebar, enter to the midband. Golly, what language is this? Hold on. Was willing to enter to go counter. So you were willing to go long. Okay. Your arrow's pointing down. I'm assuming, and 10K help me, where were you from where? Where would you go short? You don't have a fib, you have weak triggers. This is hard to read. From the small triggers right here, that's okay. So if you're thinking from right here, that's right into a fib. With every trigger above it, it's aggressive, especially not coming from a strong top. That's okay. He's going to re-annotate it. There's got to be more to it. So there's got to be something else that I don't see. All right, better dad. Strong top, odds favorable, clear path, love it. Perfect entry. I love that you got out at 79. But my goodness. Even your preset should have been hit at 12 though. It's the right spot, but man. That was fast though. That was, from entry to exit was 11 seconds. Yeah, 20 seconds. Whew, that was fast. That happens sometimes. All right, let's see. Ignore this surprise Nerf gun attack and loss of mouse movement. Ah, that's awesome. Odds favorable, clear path, perfect entry, target, and then break even on number 2, minus just a little bit. It makes sense with your large chart. One of the things, do you remember that pattern? Pivot stop out above typically produces a pivot stop out below. And it did perfectly before the market continued up. Do you see that? Look, guys, this is one of the patterns that you're going to recognize over time. Market comes down, it's perfect. Pivot stop out on the small chart. And watch this. If I draw a line from this low straight across, pivot stop out above, created a pivot stop out below. This is just a pattern, guys. This has nothing to do with the high probability trend trade. Better Dad, you did your job perfectly on that one. But one of the things that you'll be able to do in time is you'll be able to say, man, pivot stop out above, I'll exit and wait for the PSO below if I have rules met. And what it does is it keeps you from sitting through all of this. It's just one of those things where you can create little expectations based on patterns. And we've seen that one a couple times, so I wanted to post it out, or point it out, excuse me. Remember, initially, my whole focus is rules. In the beginning, my whole focus is rules, is having these advantages, is being very pragmatic, very focused on execution rather than results. And during the course of learning how to commit to these looks, you'll begin to see other things. So sometimes I'll point out the other things that I see. Oops, that's the same one. Traded into divergence hell for God knows why. God expected result. Likely poor emotional control and fear of missing out. Yep. It happens, doesn't it? Anybody ever wait too long for a trade so you make up rules? Haven't traded in 20 minutes. I need to find a way. It's okay. It's good humbling. And, you know, I don't like it when I don't like it when you guys lose, but I love it when you guys lose. I love it when you guys break a rule and the market punishes you for it. I love that so much more than breaking a rule and getting away with it, because you're less likely to trade into 4 to 5 divergences on the bottom. Because you're going to remember that sting, guys. You're going to remember that heartache. So, gosh, do it on simulator. 2 on the top 2. Yeah, those don't mean anything, though. I mean, those help, but your rules have nothing to do with divergences from the top. They have everything to do with divergences from the low. And look at this. Pivot stop out creates a pivot stop out. There's that pattern again. It happens. It happens. You know what's going to happen too, guys? And this is a true thing. This is going to happen too. Is you're going to take a trade every now and then, and you're going to say, shit, this one's going to lose. I took one this morning, guys. I took one this morning, and it was the perfect entry, and all of my rules were met, and everything was wonderful, and my management was in place, and I had to watch the trade lose because I didn't have a reason to exit. And I was like, I have a feeling, and I let it play out. And I was telling my brother, I was like, it's okay. They're going to lose sometimes, right? So you learn how to weed out the ones that are bad. All right. Was willing to go counter here to the mid band. Divergence prints, but divergence didn't print. That's what gets me there. Enter at the 92 mark back to mid band or large chart. Here's the divergence. Did not print, so no short. Okay. I like it. So what 10K is saying is that with this look, weak triggers, middle of nowhere, if he gets divergence, the expected pattern, or the pattern that repeats itself a lot, is it at least makes it back to the mid-band. And I think that's great recognition. Crude oil is just, man, they're running it. Divergence, where is one that looks like that? Here's a good example. Divergence typically makes it back to the mid-band from a bad top. So he's saying there may be a way to catch the move down to the mid-band. So I see exactly what you're saying there, 10K. It just didn't give you your divergence, so you didn't take the trade. Brilliant. Great job. All right, what's going on in the live market? Guys, this is what we call a strong trending market. 30 bars in the same direction without a reversal bar. It's a strong trending market. There's a lot of people that in a strong trending market will just keep buying the mid band until it doesn't work. Not in determination conditions. Got to have the clear path. S&P. That fits the rules, doesn't it? I don't have any stops or targets. That's odds favorable, isn't it? Potential to break. Oh no, there was a divergence on it. But there's my reversal bar. That was pretty quick, right? What do you mean mid-band, not the fibs better, Dad? Oh, on a strong trending market? Yeah, so the general consensus is when you have 30 plus bars in the same direction, keep buying the mid-band until it doesn't work. And this one didn't even give you any mid-band entries. Never gave you a mid-band entry. Because the mid-band is a moving average, and it has something to do with the moving average. I've never heard it by the fibs. No. It's always been mid-band, as long as I can remember. That's what I was taught. I mean, if you go through it and you say, well, everything is up, it's a strong trending market, resistance broke, it's going to behave as support, it makes sense, doesn't it? So there may be a little variation that comes out of this. And I guess if the mid-band is right at a fib, that's even stronger, isn't it? But that's a big run. Guys, this is where people start going, oh, I haven't gotten a trade. And they start going, I've got to go long. I have to go long because I haven't gotten a trade. Guys, this market has been running for the last hour in the same direction. You have to believe at some point they're going to get tired. Divergence says that they're getting tired, right? Smalls below the large says they're getting tired. These are where people take trades that are hope-based, not rules-based, because the rules aren't met. All the areas are on the wrong side of the triggers. It might go up, it might go down. Hell, I don't know. 50-50 trade with divergence. Had a little push, second divergence. That's a killer of 50-50s, isn't it? And look how it killed it. And look at the market dancing around this fib. Can't seem to clear it. Ugh, it's like a snake. Decisions are made. All right, there's our second hour. We made it through it. We made it through all the pictures. Great job, everybody. So we're going to go into the third hour, and you guys are going to tell me what we're going to talk about. You guys are going to say, Mark, this is the lesson that I need. Mark, here's a picture of something I'm working on. Mark, I keep seeing this pattern. Have you ever seen it? What does it mean? So when I come back in just a minute, guys, class is on you. Or it's going to be awkward silence, which is never any fun. So I'll be back in about 3 or 4 minutes, and we'll finish class strong, guys. Yeah, Wayne, I saw the leathers. You know, so when I retired from racing, I gave my leathers to a buddy of mine. And he sent me a picture 2 years later of him breaking the record for the 125 cc land speed record at Bonneville Salt Flats wearing them. I thought that was kind of cool. They were much faster on him than they were on me. And then Sid, you're saying trend trade short, trend trade long. What do you mean, Sid? Were the rules met? Anywhere? Did we get rules met for a trend trade short or long? I'm not sure. Don't see any. I do finally see momentum there, but that's a tough look. Sid, that's kind of your look right there. Once it finally breaks above and you get that momentum, everything agrees. That's kind of what you've been showing me right there. Oh, you want to see just examples of trend trade? Okay, cool. 10K. Here you tried the long on the large chart. Both triggers above the fib. All right. Mid-band. Odds favorable. Small triggers above the termination. Small chart is going red, but I waited small trigs to go blue. Entered on the mid-band. +9, then out 2 ticks below. The reversal bar is planned. Cool. So 10K, you had momentum. It had the potential to break. You took your entry. And then when divergence printed, it failed. Great management. Nicely done. And then the easiest thing to do, Sid, to go find examples of trend trades is just open up a large chart. And anytime you see momentum and path, circle a tail. Anytime you see momentum and path, circle a tail. And all we're going to do is we're just going to go look. We're going to look at those tails on a smaller, faster chart and see if they fit the rules. So this one right here was momentum and clear path. It pulls back. And let's go through the entry rules real quick. And I guess first and foremost, let's take care of the cheater circle here. So this is the look. Does everybody see it? Small's above the large are wide, the space is there, rule number 1 is met. We've gotten to the mid-band, but the large triggers aren't a full bar away, guys. This is a clear path. Mid-band is not behaving as a termination condition. The large triggers are too close. So rules met on the large chart. Everybody good with that? And that tells us, hey, let's go look to the small chart. Let's figure out an entry. So everything is screaming up on the small chart. And then, we get a reversal bar. And a reversal bar signals the beginning of the pullback, the beginning of the retracement that we're hoping for to find our entry. So at the time of the reversal bar, either mentally or do it physically, draw a box from the highest point of the triggers to the lowest point of the triggers. And guys, this box defines where the market is most likely to retrace. Everybody's good with that? And the cool thing is it means because you can see the bottom of these triggers at 62.50, you know exactly where your stop has to go, where the market should not, if you choose to take this trade. So before you ever even enter the market, let me make this a little bigger. Maybe not that big. There we go. You know exactly where your stop is supposed to go. But this is where the retracement's most likely to happen. It's most likely to bounce from an area inside of the retracement zone. So do you guys see how the box got smaller from the highest area to the lowest area in the retracement zone? This is where the market's most likely to bounce and continue with the trend. Everybody with me so far? I'm going to right click and I'm going to put a buy limit a couple ticks above the highest point. And now it's up to them, and it comes down and down. Notice how the mid band comes up. You could even go up, keep it 2 ticks. Comes down, comes down, comes down. And I'm in the market, guys. 66.25. I've got about 5 points of risk because those triggers are so split. But this is your entry. So now if we go into the KISS plan, let's do this. Initial stop is right here. First target is $100, $68.50. Second target is $200, $70.50. Is everybody with me so far? We've entered at the highest point inside of the retracement zone. Our stop is where the market shouldn't go, and our targets are predetermined at $100 and $200. But I'm waiting for, the reversal bar in the direction of the trade. Your new stop is there. Now you've got all of a point on this trade. It's going in the direction of momentum. It's going in the direction of your clear path. Your stop is where the market shouldn't go. And boom, first target hit, KISS plan. Now you're break even. You have absolutely no risk on the trade. First profits have been taken. It either goes to the second target or stops you out. Boom, $300 trade. And then Sid, check this out. Whoops. Let me go back to it. If you come back and put a circle on the bottom of that tail on the large chart, it's your entry on the small chart. That's your study tool, guys, to get good at this. And with all that momentum, it just kept going all the way to trouble. KISS plan has you out early. With a little bit of study and practice, you might hold that trade for the bigger move. But that's your example of a trend trade long. Now let's go do the same thing for the short. Not the best momentum. Let's go take a look at it. I'm about to crash it. All right, my ninja's about to crash because I kept scrolling. But that's exactly how you guys can study it. Let me pull this back up. Sorry about that, guys. That was my fault. That was ninja abuse. Yeah, Andy, it won't take you long to figure snag it out. One of the things I did, Andy, is like when you have an arrow, it shows you like 50 arrows here. I just deleted all of them except the one that I want to use. I kind of streamlined mine because I have OCD. On my shapes, I keep them different because I like to do the whole areas and stuff. All right, so that's coming back up. Did that make sense, everybody? That's a great way where you can go through without actually being in a market and snag it for dummies. But you can go back and you can practice your entries and you can talk through it. Man, that was a good run, wasn't it? You feel like you're starting all over again? You must have had a great time in the Caribbean. Good. Whoa. Why is that circle so big? Vacation brain. I love it. My drawing tools are going wonky here. Let's open up crude oil. Maybe we can find one. I bet she did, Wayne. I love a beach. I love the beach. I love a vacation with a girl I love too. That's a lot of fun. That was good stuff. Sid, you've been taking the momentum trades lately, but that's a great way to go study entries just to get good at it. Let me see if we can find one on crude oil. Not a lot of clear paths on crude oil. Fib's doing their job. Here we go. Well, that one was into a termination. That wasn't right. This one, though, didn't quite hit the one-to-one. So I'm going to scroll back and find that circle. This is kind of funny. There's your first entry. There's your next entry. There's another entry. There's your final entry. And then it finally goes down. But it never gets outside of the area. That one would be a little harder. Yeah, they did, didn't they? They launched that thing. And it came straight from a termination condition, Pete. This is what amazes me. I don't know if you guys, if you go back and look at it, look at how powerful these fibs are. And they break, right? And they hold, and there's bounces. But just knowing where those bounces could happen, knowing where those tops and bottoms can be, it's pretty awesome. But then you have to have rules. You have to have rules. You can't just say, oh, look, it's a red fib, let's go, right? Because sometimes red fibs break. Sometimes they hold even with odds favorable momentum. So you'll find your way, but you've got such an advantage. And if you talk to yourself in advantages, life gets pretty good with this software, guys. It really does. The hardest thing you'll ever do is nothing. The hardest thing about day trading isn't learning a pattern, guys. The patterns are easy. It's sitting on your hands when the pattern isn't there. You guys remember when you were kids and your parents said, hey, look both ways before crossing the street? Because bad things happen if you don't. All right. Weak bottom. Odds favorable. Absolutely nothing in the way. Perfect entry. Quick profits. And look at that. 3 divergences printed too. You got out break even before the divergence got bad. But isn't that cool? Small chart showing the change. You still take the perfect entry. Look at that. Pivot, stop out, pivot, stop out. Damn it, better dad. There it is again. Kiss plan, baby. There's nothing better than making money on a trade that fails because you're willing to get paid. You'll learn to believe that a little bit. You guys have seen Paul that comes in this room a lot, post his trades. He always takes profits at $100. He always secures his money. And then that's what the second contract's for. Let it run if it's going to run. Good stuff. Good stuff. What's up, Ed? I see you in here. You know, one of the things that I do sometimes is if people aren't where they want to be, and guys, you will find yourself in a position where you're not where you want to be. I encourage you, go back to this plan. Give it 5 days. 5 days of doing your best to follow this plan. It's amazing because the success that it brings, it's just, God, it can reset a bad week, a bad couple days, a bad month. Adherence to rules, and I'm such a big fan of it. You might be too one day. What do you want to talk about, guys? I got so many of you in here. And Wayne, let me know how handing your racing licenses and pilot licenses goes with the cops next time you get pulled over. That would be hilarious. I hand them my concealed carry. In Texas, that's almost a get out of jail free card. You could tell the speed was increased. It's nice. Fast computers are a good thing. Fast internet and a fast computer is a great thing. And back up. They're just grinding and crude. Tried your medical license once? You know what? My wife, when she was in scrubs and her badge, that was get out of jail free card once. She got pulled over at the front of our neighborhood. Oh, I love this story. It's just a funny story since there's no pictures to look at. And she had worked her 12-hour shift and then got called back in. And she had been working about 26 hours straight in surgery. Drove home. We were an hour from the med center. And she gets pulled over for swerving, pulling into the neighborhood. And she was just exhausted. And the cop goes, all right, I'm going to go check your license. Comes back, and my wife was sound asleep in the front seat. And he's like, But she got away with it because she was a nurse. She literally fell asleep in the front seat because she had to turn down her music and everything for the cop. All right, Ed, you said it missed you. Termination, momentum. So, Ed, let's talk about it. At the time of the reversal bar, that's the area, it's the only area that you have for a bounce, Ed, is the mid-band. That's your bouncy thing. The triggers let you know that your stop needs to go about right here. That's a good look, though. Tripped over a couple pennies on that one. Why did you use the trigger lines rather than the mid-band? Because the look is beautiful. Yeah, Pete, that happens sometimes. Fell asleep at a stoplight. I've come close. Hell, I've almost fallen asleep on the highway. Don't drive tired. They say it's worse than driving drunk. And I love everything about this. I think that you tried to call your shot instead of getting in where it was most likely to bounce. It's a good look. Well, so Ed, that's not a matter of... So your stop being too tight has nothing to do with the right entry, right? It has everything to do with your unwillingness to put it where it doesn't go. So Ed, on something like this, think about this. Perhaps, maybe, let's talk about it. Let me know what you think. We may be able to find a little something for you. So Ed, you're like, I know the mid-band. Do you know the mid-band's the right entry? Let me make sure of that. You know you should get into the mid-band, right? But you're like, I don't want the risk. I don't want to leave that on there. So Ed, something you can do. Force the reversal bar. Force the confirmation bar. Force the market to go in the direction of your trade. And then a stop just below it makes sense. So instead of, because you struggle with the hoping it goes up and you don't like the risk. Get that confirmation bar off the area. Put your risk behind it. At least then the market's told you, hey, Ed, you read it perfectly. You know where we're going up from. You love this spot. We love this spot. Let us prove to you that this is a good trade for you. Does that make sense, Ed? That might help a lot. It might help with that little bit of fear, right? And let's see if we can find an idea. And I think this might be the same one right here. You're like, I think it's going to be the mid band. I love the mid band. I've got these. This is good. But let me force it to go in the direction, right? And then you've at least got a fighting chance. Wow, Pete, you fell asleep on a motorcycle? That I've never done. And I've ridden my motorcycles pretty tired. I can't imagine that. What's your question, Ed? I got you. Guys, I love the confirmation bar. If you're just not feeling it, right? It's just not as good as you want it to be. You pay a little bit for confirmation. Yeah, that would do it. Well, you should have been doing meth with everyone else, Pete. You would have never fallen asleep. I'm just kidding. Don't do meth. Make your teeth fall out. Used to talk about this for people in the beginning when you're learning to take these entries and you're learning to get comfortable with these entries. Always go through the process. This is where it could retrace. This is where it could bounce. And guys, if you're just not cool with selling on the way up, that reversal bar, it establishes risk. It helps. Instead of it being up here, you can put it right there. That helps people a lot, I think, mentally, until you get that trust in. If you're getting in where? Here? How's that not jumping in? Well, Ed, this is an incomplete picture, isn't it? So let's do this. Let's make it a complete picture. So the large chart says strong bottom coming from a term. Large chart has momentum. Large chart has a clear path, right? So Ed, the rules are met 100% on the large chart. Would you agree? You're good. You're golden. You're looking for an entry. This is where the market is most likely to bounce. This is where the market shouldn't go if it's going to be a winner. So Ed, let's talk about the expectation. Your expectation is to get up here to these fibs, right? Because it's a trend trade, because you have momentum, because you have a clear path all the way to the area. You're looking to go to those fibs. You're looking to go to that trouble up here. So this isn't jumping in if you get in right here. This is entering after confirmation. Right there. Now, if you just get in right here, that's jumping in, Ed. But this is confirming the up move from an area at triggers because the rules are met. Does that make sense? The difference between the two? Getting in right here before you get to the entry point, that would be jumping in. Getting in over here before the reversal bar and the pullback, that would be jumping in. This is getting in with confirmation. Well, so let me show you a trick, Ed. Let me show you a trick. So Ed, we have to use our imagination for a second. Hold on, let's look at this one. Pull back, pull back, pull back. So, Ed, let's say that all my rules are met for a short. Guys, absolutely no rules are met for a short. And Ed, you're saying I'm going to force the market to confirm. I'm going to force the market to go down in order to get into this trade. And I forgot to connect to live data, so who knows where it's going to be. Here we go. That actually messed up my example, though. So now we have to, okay. You're saying, Ed, I have to have a short. My rules are met. They're clearly not. So what you can do is right click and put a sell stop limit. And I don't know why it's confirming. And what this is this is saying in order to enter this move, I have to get a reversal bar. So it's not a jump in, it's a calculated entry with confirmation off of the resistance. And I'm not saying that this is a trade. This is not a short trade. This fights everything in a strong trending market. But instead of trying to time it out and leaving yourself to your own resources, get that stop, that sell stop on there. Then you're not chasing it. You're forcing confirmation. There's a big difference. And what does the language do to your brain? Because if I say I'm chasing it, then I'm already in a panic and I feel like I screwed up and I'm more likely to move stops and targets. If I say I enter with confirmation, well then I'm like, oh, this is amazing. I've got confirmation. It's going with everything good. And you're more apt to hold for your target. Does that make sense, everybody? Language is important. There's your gap theory. Large triggers a full bar away. So Ed, I think you had it dead to rights, man. 100%. And if you entered with the first confirmation, it came back, but nothing changed. Nothing ever changed. It stayed odds favorable momentum. It stayed cleared path. And it stayed area right in the retracement zone. And it's easy money for you there. But I think that's the feel-good entry with confirmation because risk is established. And all you're doing is you're trying to trick your brain a little bit. You're trying to make your brain feel better about risk. Because when you get in and you put your risk behind a reversal bar, you're telling yourself the market's doing everything I thought it was going to do. It's going up with that momentum. It's going up with that clear path. It's going up from that area. And it feels good. And it just means that you've redefined where the market shouldn't go. Your read was spot on. 100% spot on. Termination reverses the market. Odds favorable momentum. Potential to break. If I take the pullback to resistance, I know that my stop has to go up here. So if I'm not okay with that, I'll choose not to take the trade. Maybe if they pull back, we'll use the stop entry. It's a 50-50. It's not a strong top. Everything says down. The momentum is strong. If it pulls back, I'm not just going to jump in. I'm going to force it to confirm. Is everybody cool with that? We're going to see how to do this live if it sets up for us. Confirmation doesn't guarantee a winner. It just gives you a place to put your stop. So as it pulls up, I'm going to go ahead and activate my sell stop. Well, it didn't make it to the area, so I probably shouldn't take that one yet because it's not a confirmation off of the area. I'll give it a second. If it pushes up, come on, push up, market. You can do it. But this is how it works. I just don't want to sell it on the way up. I don't want to put that much risk on a 50-50 trade. So I'm going to let the market redefine my risk. And a reversal bar from the middle of nowhere is not confirmation. Trina, I need confirmation from an area in the retracement zone. Does that make sense? Otherwise, it's not confirming anything. These are just fluctuations on the way to my best entry. And if I know that price can retrace to here and I know that it can bounce off of these, I don't want to be in down here. Because if it goes and does what the pattern says it usually does, I'm going to have to sit through all that nonsense. Now we're like a tick below. So we'll do it. We'll put a sell stop in. Ideally, it goes a little higher. But this is just for the sake of education, guys. Many of you are saying, but Mark, it's divergence on a 50-50. That's not your best look, Novak. I know it's not. And the cool thing is with confirmation is if it never gives a confirmation bar, guys, you'll never take the trade. You won't just jump in. You're literally, there we go. Look at this. We're in our area. Now we're waiting for confirmation. Now I'll take it. If I get a reversal bar, then I'll enter the trade. If I never get a reversal bar, guys, there's no trade for me. Does that make sense, Trina? This is why we wait for the areas. I'm at the top of where it could, oh gosh, that's ugly. Done. No confirmation, no trade. Boom, ladies and gentlemen. How cool is that? And that was a 50-50 with divergence from a bad top. That may have been the best lesson you ever get. Did that make sense, Trina? You're back. I like it. All right, gap theory again, better dad. You take the entry, you get paid, and then you take it again with huge risk. Awesome, Ed. I hope that was helpful. And then when it closes the gap, better dad, nothing changes. There's where confirmation bars are great. I don't want that much risk. I'll get in with confirmation, ride that thing down. You, my friend, trust stops. I mean, great job. Nicely done, better dad. Here's profit target 2. Was holding for the fib, but the 1-to-1 bounce made me think, just take the money and run. Nothing wrong with that. There's nothing wrong with that. They went to your target. But if you're going to take it at the 1-to-1, take it at the 1-to-1. This is fear. Better dad, this is the, oh shit, it might bounce again. Not the 1-to-1 could create a bounce. I know, I recognize it. I've done it 100 times. And it went right where it was supposed to go, didn't it? It's okay. Panic is a part of developing trust. So your job, better dad, is to take this picture and say, panic exit. It was on its way back down to my original target, but I got fearful and changed my plan. Either exit at the 1-to-1 initially, or be willing to hold. And that's part of developing trust in the management plan. And your management plan will change over time, without a doubt. But these little bounces, these little fluctuations will destroy a brain. Because you forget that the large chart is strong. You forget that the large chart is down. You forget all these advantages that are getting you into the trade anyway. And if you entered here, it's no different than here. But those 10 ticks freak you out, right? Have you guys been in a trade? I love this. Watch this. And you stop looking at momentum. You stop looking at everything. The only thing you look at is this number. Does anyone else do that? 75, 25, 0, 25, 50, and you're exhausted. And it's, oh my gosh. And guys, this is right into a termination condition. But you will get so focused on a tick or two, watching that number change, that you'll close out and you'll forget why you were in that trade in the first place. One of the things you can do, guys, is right click and go to properties in Chart Trader and stop showing yourself what's there. Because if you do that, you see where you got in, but you don't see where you're at. You don't see the negative 25. That's what creates fear, guys, is watching this number. This market says up, right? The trend is green. Your problem is the fib. Obviously, you're not going to trade directly into a fib, but if you get in down here, nothing has changed at all. Everything still says up. So, guys, you've got to figure out what your weak spot is so that you can fix it. And the only way to figure out what your weak spot is trading, is doing things, right? Better Dad, you've got to say to yourself, I get scared when I get close to targets because I don't want to give it back. Well, maybe you need to take profits five ticks off of a fib. Just don't let it get close. Or if there's a 1-to-1 right in front of the fib, just get paid there. To hell with the 37.50 that you could have made. Appease your brain, because when your brain feels good, you're more likely to be consistent, guys. My brother and I have such different trading plans. He's so much better at management, to be honest with you. And because he's so much better at management, he takes a lot of those trades like Pete does, or like Wayne's capable of taking, where he gets in and I'm like, that doesn't fit my rules. He's like, yeah, but I've got 10 ticks to get back to here. He goes, I'll just get paid and go break even, and whatever happens, happens. And my brain doesn't do that. My brain, because I teach this class every day and I talk about termination conditions every day, I can't bring myself to get comfortable trading into them. And that's okay. It works for me. Everybody's different. But you got to go through and you gotta break a few eggs and make some mistakes and figure out what your thing is. What makes you happy? What keeps you from being happy? And then embrace it. Find a way around it. Reversal bar may be your way around it, right? Getting paid 5 ticks before the fib instead of hoping the fib gets hit. That might be your way around it. But you're only going to find that through repetition. And man, show me 5 of these, I'll point it out to you. This is what I noticed, Better Dad. I noticed that on your first contract, you love to get paid a little bit above trouble, but on your second contract, you can't decide whether or not trouble is a factor for exit. So maybe get paid and take a lot of pictures. And what did the large chart say? Did the large chart say that it was going, right? Did the large chart have momentum? Was a large chart still a clear path? Are you letting the small chart talk you out of the advantages on the large chart? So that's how it works. And then it's just do it again. Do it again, do it again. Over and over until it becomes easy. Over and over until it becomes second nature. You like to let it ride. And I'm the exact opposite, Better Dad. I like to get paid. I always feel better about money in the bank. I would rather take $50 20 times than, and obviously this is the wrong trade, but I'm like, oh no, I'll take smaller profits, right? Instead of hoping, instead of wishing, instead of wanting. I'll take $100 on a trade and go break even. I don't care. And the reason that I'm like that, Better Dad, is because I know the next trade is coming. I know there's more opportunities. I know that my only chance at making money isn't directly into a 1-to-1. That eventually, this is a good example. If I were going to take the 50-50, whoops. that's doing that.
Order submitted.
It's only 50-50. I like it. I'm good. You're the guy at work when nobody will do it, I'll say, let's give it a shot. If I'm going to force confirmation, it's a 50-50. It has two divergences, but everything says up. I'll force confirmation because then my stop is below the reversal bar. Doesn't guarantee a winner. Rules aren't met. And that's my first trouble. But that's why that's why I give you guys a plan that says don't take 50-50s with multiple divergences. Because stuff like that happens. Confirmation doesn't guarantee. It just gives you a place to put your stop. It doesn't undo breaking rules. Strong trending market, mid-band till it stops working. We talked about that, right? That may have been the first time it actually made it to the mid-band, but it worked. And the market's still going up, and it's still a strong trending market. I love this stuff. On the weekend, John Novak and I are going through some plans and running strategies and doing stuff. And I will spend my day off working all the time because I love finding these patterns. I love talking about stuff. Better Dad, there is your pivot stop out above. It's created the pivot stop out below, but the rules still aren't met. So patterns aren't rules. Rules are designed to keep you safe. Yeah, so when I say strong trending market, Morgan, at least 30 bars with no reversal bars. And then that's where the triggers do that train track thing. That's where you'll see it, is typically after that. Faux show. Joel, great top. I like it. Strong triggers, dig it. So the only challenge with this one, Joel, is that mid-band could create a bounce back up to the large right here. And you take the first one, 1, 2, 3, 4 divergences. So you sold a confirmation bar after the third divergence. Triggers rolled, smalls are down, you're below. Love it. You get paid. And then when it pulls back to the trend trade, you do it again. Nice job, Joel. You hate rules? You think there's a restraint and there's a restraint from blowing out your account? Yeah, they are, Ed. It's I'm not a rules follower, not by nature. I'm a rule bender. I'm a find an exception guy. And I'll tell you guys honestly, when I look for exceptions to my rules, I lose more than I win. That is the only thing that I'm 100% sure about in trading, is that when I stop trading rules and start trading opinions, I get the ever-loving crap kicked out of me. And then I get mad, and I get it kicked out of me even more. And it seems to be that way for everybody. Joel, I love how you did this, man. Start with the strong top. Everything says that market's going down. But you let it, your patience is good. When the smalls get below the large, so much better when they're above the large. Let there be some weakness. Great patience. And then make sure you get paid. It's just momentum. And then you get back in, you wait for the confirmation there, and you're like, well, shoot, let me just get paid again. I mean, I love everything about this one, Joel. And it all starts at a strong top, huh? Better Dad, 50-50, strong bottom, odds favorable, perfect entry, quick profits. Profit target 2 is 2 ticks below the 1-to-1. Stop loss got you out. So you ran it super tight when you were that much in the money. Nothing wrong with that. But that's it right there. And then Ed, if you didn't want to get it on the way down, getting it on the way up, produces the same results. Does that make sense? If you're not cool with this one, guys, confirmation bar. Because the large chart says go, because the rules are met. Reversal bars, when the rules aren't met, all they're going to do is get you into a loser with your stop in the right spot. And we may have just had a big aha moment for you. So, Joel, why do you suppose that's a good bottom? Because all I see is a divergence from the middle of nowhere. So the rules, and I'm going to go back to language. The rule, or the language, the definition of a strong bottom is a termination condition that creates a reversal. And Joel, when it's a single divergence on its own, it's not a termination condition. It's just a loss of momentum at a pivot. That's all it is. Does that make sense? In order for it to be a termination condition, price has to reach it, right? But let's dig deeper. Let's dig deeper. I believe it was 10K this morning that said, hey, Mark, when I get divergence from the middle of nowhere, I've noticed that the market tends to make it to that mid-band. Does anyone remember that? 10K was nice enough to share a pattern that he's studied and recognized. The divergence from the middle of nowhere, a lot of times it hits that mid-band. So we've got that going for us. Small triggers are up. Large triggers are up. Momentum's pretty outstanding, and we haven't reached the mid-band. Every indicator's up on the small chart, and it pulled right back to support, right at the triggers. Everything says up. And Joel says, wait a minute. This isn't perfect. My triggers are below everything. No, you were directly into a termination condition, 100%. Every trigger is below those fibs, Joel. Every one of them is below those fibs. Do you see it? So what you have here is a momentum-based trade. You have strength on the large chart, strength on the small chart. The fibs help you define where the bounce is most likely to happen with that look. And you wait for confirmation. You don't hope it happens, you force it to happen. And then once it happens, you just ride that momentum, which is beautiful. It's a great trade, but it's not even a 50-50. It's a momentum style trade. It's letting the small triggers break through the fib with momentum on both charts, and it snaps right back to the fib. And just giddy up. Nice job, Joel. Oil got no business being at 71.21. Was hoping for a third divergence and a reversal at the fib, but it broke instead. Love it. Pete realizing, I'm not just going to go short. I'm going to force it to reverse. Guys, one of the things about a strong trending market, this is just me echoing things I've heard my brother say. If you truly have a strong trending market, he'll force the large triggers on the large chart to reverse before he ever tries a short. And do with that what you will. But John Novak says, if I'm in a strong trending market, I won't even entertain the idea of a short until the large triggers go from green to red. Something to think about. I like where your head was though, Pete, using patterns. And if nothing else, just to get back to the lower fib. Good stuff. And now we're still strong trending. Everything says up. Ed, weak triggers, but you have room to the target. Multiple divergences, weak triggers, everything is above fibs. You buy the fib, and you held to trouble. Nice job, Ed. No, I think that was a good one. Ed, usually I see you exit right here at those triggers before that bar even prints. So this is actually pretty good, dude. That's a 4-point trade for you. Your brain hates 4-point trades because it plays the what if game over and over. So that's a victory, Ed. And look at this. It comes back to the termination, starts back up, little retest. Entry is rock star, dude. Nicely done. At the fibs, weak triggers. You get paid on the way up. You stay out of the mess. Termination rolls, pulls back to the small triggers. That is the 2004 Nexgen Edge trade. And it looks just like this. Pull back to the large triggers, which is the pullback to the small triggers. And you just execute beautifully. Great job, Joel. In 2004, your trade hit the scene. Let a fib hold, let the small triggers roll, sell the pullback to the small triggers. I mean, expertly. Nicely done. Just strong trending, Pete. Just strong trending. Somebody in crude oil got a wild hair and said, let's make this mofo go up. And that's exactly what they're doing. All right, guys, I'm going to stop YouTube because we're